Have you ever looked at someone else's Roth IRA and felt that little punch in your stomach? Like, man, they're doing it right and I'm behind. I've been there, and that feeling can make you do something that seems smart in the moment but costs you later. You pick an investment because it sounds safe, or because everyone online calls it the best, or because it pays a big dividend and you think, perfect, Roth means tax-free, so I should put the biggest payout in here. That idea feels logical, it feels grown-up. It feels responsible, but it can also be the exact reason your Roth grows slower than it should. Here's the conflict most people never hear. A Roth IRA is not just any account, it's a special kind of tax-free box. And because that box is limited, what you place inside it matters more than people think. Some popular ETFs are great, just not great for this box. And if you use the box the wrong way, you don't lose money overnight. It's worse than that. You lose time. You lose years of growth, quietly, and that can mean thousands of dollars in missed opportunity over a long life. So in this video, I'm going to walk you through 4 ETFs that can be strong long-term picks for a Roth IRA, and I'll also explain a few popular ones people love that often belong somewhere else. I'm not telling you what to buy, no promises, no guarantees. This is just education to help you think clearly. And the big twist is simple. The best Roth ETF is not always the one that looks best today. Let's start with the one simple rule that makes all of this make sense. Think of a Roth IRA like a special box you can't use for just anything. It's a tax-free box as long as you follow the rules. Here's what that means in plain words. When you put money in, you already paid taxes on it from your paycheck. After that, if the money inside the box grows, it can grow without you getting taxed again. If an ETF pays a dividend inside the Roth, that dividend can come in without yearly tax bills. If your ETF goes up in value and you sell it later for more than you paid, you don't get hit with the usual tax bill inside the account. And when you take money out the right way later in life, the goal is that it comes out tax-free too. That's why people love this account. Not because it's exciting, because it's powerful. Quietly powerful. And this is the mindset that changes everything. This is not a trading account. This is not a let me jump in and out account. This is your future you account. The kind of account you build when nobody's clapping, when nobody's watching, and when the best move is often the boring move. So here's the big question that decides whether this works or not. If this box can protect growth from taxes, what should you put inside it? Because if you put the wrong kind of thing in the box, you're not breaking a rule, you're wasting the advantage. And most people do it without even knowing. Here's the one rule that makes Roth investing feel simple. Roth space is limited. You can only put in so much each year, so you want to use that space for things that can grow a lot over a long time. That's it. That's the rule. And notice what I didn't say. I didn't say this ETF is good and that ETF is bad. That's not the point. The point is right place, right job, like putting food in the fridge and soap in the bathroom. Both are useful, but in the wrong place, they don't help you. Some ETFs are great, but they're better on a different shelf, like a different kind of account. And this is where a huge myth shows up. People think more dividends means more wealth. Not always. Dividends are nice, but a high dividend can also mean the ETF is built more for paying you now, not growing as fast as possible over time. And if your Roth IRA superpower is tax-free growth, then filling it with slower growth picks can hold it back. Again, not because those ETFs are evil, just because the job doesn't match the box. So next, I'm going to show you 3 ETF types that feel perfect for a Roth, but often can quietly cost you later. No shame here. A lot of smart people do this. It sounds logical at first, but once you zoom out, the trade-off becomes clear. Remember the whole point of the Roth box. It protects growth from taxes. So if you use that space for things that usually grow slower, you might be giving up the best part of the Roth without realizing it. First are high dividend ETFs. A popular example is a fund like SCHG, which has paid a dividend around the high 3% range in some periods. When people hear that, they think, great, I'll put it in my Roth so those dividends come in tax-free. And yes, the dividends can come in without yearly taxes inside the Roth. That part feels like a win. But here's the catch. Many dividend-heavy ETFs are built more for paying you now than growing as fast as possible over decades. so you can end up with a smaller tax-free pile later than you could have had if you used the Roth space for higher growth. High dividends can feel like progress, while quietly slowing the long-term snowball. Second are REIT ETFs, like VNQ or SCHG. These are real estate funds, and they're known for paying out big dividends. That's not an accident. Many REITs are required to pay out a large portion of their taxable income to shareholders, which is why the payouts can be higher. Again, it feels like a perfect Roth pick because tax-free dividends, but REITs often act more like income tools than pure growth tools, so you're still using premium Roth space for something designed to send money out regularly instead of something designed to grow as big as possible inside the box. Third are bond ETFs like BND. Bonds can be useful. They can smooth out the ride. They can help you sleep at night. But over long periods, bonds usually grow slower than stock-based ETFs. And since Roth space is limited, putting slower-growing bond funds in that box can limit what the Roth could become over decades. Bonds can make sense in many plans, especially later in life. But in terms of best use of Roth space, they often belong somewhere else. And I want to be crystal clear. These ETFs are not bad. They can be great. They just often work better in a different account. This is about matching the tool to the job. The Roth's job is to protect your biggest growth from taxes. So the question becomes simple now. Okay, so what does belong in the Roth box? Let's build the 4 ETF dream team, starting with the boring one that wins.
Let's start building the Roth Dream Team with the one ETF that is almost boring on purpose. It's called VTI, which is a total U.S. stock market ETF. Here's the simple idea. With one buy, you get a piece of the whole U.S. market. Big companies, medium companies, small companies, even tiny ones. It's like owning a little slice of thousands of businesses instead of betting on just a few. That matters because no single company gets to decide your future. If one company has a bad year, it's only a small part of the whole. The rest can help balance it out. Now let me make this real. Think about the person who keeps investing when the news is ugly. Their coworkers are saying, "I'm waiting until things feel safe." Their feed is full of scary headlines. Their account is down. It feels bad. But they keep their plan. Same day each month, same calm move. They don't try to guess the perfect moment. They just keep buying. And over time, that steady habit is what often wins. Not because they were lucky, because they didn't quit. That's why VTI works so well as a backbone. It's simple. It spreads your risk, and it lets you ride the long-term growth of the U.S. without needing to pick winners. But now a fair question comes up. If VTI already owns almost everything, why do so many people still choose an S&P 500 ETF instead? The S&P 500 is like the scoreboard everyone looks at. It's the most common "how is the market doing" number people talk about. An S&P 500 ETF like VOO or IVV is built to match that scoreboard. It holds about 500 of the biggest U.S. companies. These are the giant names you already know. And because these big companies are such a big part of the market, the S&P 500 often feels like the main event. It's a clean, simple way to own large U.S. companies, and it has been a core choice for many long-term investors. Now here's the contrast. VTI is the S&P 500 plus more. It includes those big 500 companies, and then it also adds mid-size and small companies too. So both ETFs can be great. They just have a slightly different flavor. VTI is the whole country. VOO or IVV is the biggest 500. And here's the mistake I want you to avoid. Some people buy both VTI and VOO because they think more ETFs means more diversification, but they don't realize how much these two overlap. They end up holding the same top companies twice without meaning to. It's not a disaster, it's just not as different as it looks. The better move is to understand what each one does, then pick the one that fits your plan as your main U.S. core. Now for the twist. If Roth growth is the goal, there's one ETF type that can boost your results over time, but only if you pass a behavior test. Now we get to the ETF that can feel like a growth boost inside a Roth. This is a growth ETF, like VUG or SCHG. The simple idea is this. These funds lean more toward companies that are trying to grow fast. They often put more weight on areas like tech, healthcare, and brands people spend extra money on. When these types of companies do well, they can rise faster than the market. That's the upside. But there is a trade. Growth can drop harder when fear hits the market. The price can swing more. It can feel rough. And that leads to the real test, which is not about math, it's about you. Here is the behavior test. Are you the type who panics when something falls or the type who stays calm? Because with a growth ETF, the biggest danger is not the ETF itself, it's what people do with it. Let me tell you a short story. Two people buy the same growth ETF, same day, same price. Then the market drops. The first person checks their account every morning. They feel sick. They start thinking, I knew this was a mistake. They sell when it hurts the most, just to feel relief. The second person sees the same drop and thinks, okay, this is what it does sometimes. They keep buying on schedule. Months and years later, the difference between them is not luck, it's behavior. This is why I say it this way. Volatility is not the enemy. Panic selling is. If you know you will sell when it gets scary, a growth ETF can hurt you. If you can stay steady, it can be a powerful piece of a Roth. Now we've got one more big debate. People argue about this all the time. Do you need international at all? Some people skip it for a simple reason, and I still keep it for a simple reason too. Let's talk about that next. International ETFs are the outside the US piece, like VXUS or IXUS. The one key idea is simple. Don't bet your whole future on one country being the best forever. Yes, US stocks have done better than many international stocks in recent years. That's true. But investing is not about replaying the last few years. It's about being ready for the next few decades. And the future can change. So international is like a backup plan, a hedge, a way to spread your bet. Here's what these ETFs hold in plain words. They own companies outside the United States. That includes big, well-known companies in places like Japan and Europe, plus companies in faster-growing places too. People often split the world into two simple buckets. Developed markets are places that are more mature and stable, like Japan, the UK, and parts of Europe. Emerging markets are places that may grow faster but can also be more bumpy, like parts of Asia and Latin America. So when you own an international ETF, you're not saying, I hate the US. You're saying, I don't know the future, so I'm spreading my risk. And if international markets do lead in a future decade, you'll be glad you had at least some exposure inside your tax-free box. Now let's put this together in a simple way, because knowing the ETFs is one thing. Knowing how to combine them without overlap and without overthinking is the real win. Next, I'll show you 3 clean Roth setups that keep you consistent. Here's how to keep this simple, because simple beats complex for real people. Most investors don't fail because they picked the wrong ETF. They fail because they picked something they couldn't stick with. So instead of trying to build the perfect plan on day one, pick a clean setup that matches how you actually behave when the market drops. These are examples, not advice, just simple templates that many people use. The first setup is the simple one-fund core. This is for the person who wants one main choice and wants to move on with life. A common way to do that is using VTI as the core. You own a wide slice of the US market in one move. It's easy to understand, easy to keep, and easy to keep adding to. This setup isn't flashy, but it's powerful because you're more likely to stay consistent.
The second setup is the balanced two-fund world mix. This is for the person who wants to own the US and also own the rest of the world. You pair a US fund like VTI with an international fund like VXUS or IXUS. That's it. 2 pieces. One covers the US market, the other covers the world outside the US. It's still simple, but it spreads your bet so you're not putting your whole future on one country always leading. The third setup is the Slight Boost 3-fund setup. This is for the person who wants a little extra growth tilt, but still wants to keep it controlled.
You use a core like VTI or an S&P 500 fund like VOO or IVV. Add an international ETF like VXUS or IXUS, and then add a smaller piece of a growth ETF like VUG or SCHG. The key word is smaller. This is not about going all in on growth. It's about a modest tilt that you can live with when things get bumpy. And here's the watch time truth that matters most. The best setup is the one you can stick with during a market drop, not the one that looks smartest on paper, not the one that sounds impressive. The one you will still follow when the headlines are scary and your account is down, because the market will test you at some point. So pick a setup that matches your personality. That leads to the last thing, and it takes about 20 seconds. How do you choose the best setup for your personality? Here's the quick "which one are you" test. If you want the least thinking and the most simplicity, you're a keep-it-simple investor. You want one core and you want consistency. If you like focusing on the biggest U.S. companies and the classic benchmark people track, you're an own the Big 500 investor. If you want a little extra growth, but you know you can stay calm during drops, you're a small growth tilt investor. And if you sleep better knowing you're not betting on one country alone, you're a global hedge investor. Let's recap fast. The 4 Roth-friendly ETFs we covered were a total U.S. market core like VTI, an S&P 500 core like VOO or IVV, a growth booster like VUG or SCHG, and an international hedge like VXUS or IXUS. And the categories that often don't belong in the Roth box because they can waste the tax-free growth advantage are high dividend ETFs, REIT ETFs, and bond ETFs. Not because they are bad, just because they often fit better somewhere else. If you want the next step, the next video is where I'll make this even easier. I'll show simple percentage mixes based on different risk styles, so you're not guessing and you're not copying some random portfolio online. And I want to hear from you in the comments. Which type are you? Keep it simple, Big 500, small growth tilt, or global hedge? And what would make you actually stick with it in a down year?